Now, anyone who knows Rashaad will know that he's not one to shy from some controversy. So your surprise is gold at over $3,000. So it's actually below $2,000 today. In what world would that be the case, do you think?
So Linda, we've always viewed gold as a very important part of a multi-asset portfolio. It's a store of value, it's a hedge against inflation over the long term, it's a hedge against crises, especially when these crises are geopolitically driven. And I think next year gold will surprise a lot of people with its positive performance and prove its importance for two reasons. Firstly, I think we could see central banks start to buy bonds again and reverse the tightening that they've had over the last 2 years. If central banks buy bonds, that's monetary easing, that's good for gold. The second reason is because of geopolitics and the rising importance of gold in what is currently a US dollar denominated system. So let's start with the central banks. What I've got here is a chart of the major central banks' balance sheets, and we can see how dramatically that's increased since the financial crisis. It's gone from in 2007, it's gone from 5 trillion and got to almost $33 trillion. And I don't think people fully appreciate how much of a backstop this central bank support has had for the bond market, how it's depressed yields and enabled governments all around the world to issue a large amount of bonds. In the last 2 years, that support has gone into, the central banks have been reducing their balance sheets, they haven't been supporting the bond market, and it's no surprise that we've seen 3 years of very poor bond performance, and we've seen yields move up quite significantly. Now, the question is, after 2 years of decreasing balance sheets, can they continue to decrease those balance sheets and sell bonds next year, or will they first be forced to reverse those decisions and buy bonds again? Let's look at some numbers here, and I'm choosing the US because their fiscal position is extremely dire. On the left-hand side, we've got the US fiscal deficit, and this shows that how they're unable to control their spending. They've had a consistent spending problem. It got out of control during COVID, and they really haven't been able to bring it back in line. This year, they expected to have a deficit of 1.7 trillion. That's in a year when the US economy is growing and unemployment is close to a record low. Over the next 2 years, the deficit is set to be close to $2 trillion a year. That's if we don't have a recession. Now, you take that $2 trillion and you add the quantitative tightening that the Fed is doing of $95 billion a month, that adds up to over $1 trillion. And if you combine those two, you're looking at over $3 trillion of bonds which have to be absorbed into the market. This year, you saw a lot of purchases from funds, from retail investors, and you managed to absorb those bonds, albeit at much higher yields. The question is, will the market be able to absorb another $3 trillion in 2024, or will the central banks be forced to backstop the market as they have for a very long time? That's the economic case for gold. The second case is geopolitical, and it's the increasing role of gold and the diminishing role of the dollar. We can see that central banks have been amassing gold for the last decade, and they stepped that up in 2022. And these last 2 years, we've seen record central bank purchases of gold. I think a lot of that is driven by the weaponization of the dollar. When Russia invaded Ukraine, their central bank assets were frozen, and I think it highlighted to the rest of the world that their reserves, their savings in dollars only belong to them if they are in line with US policy. If we're seeing geopolitical contestation, I think countries will prefer to hold a neutral asset like gold rather than an asset which can be confiscated like the dollar, and I think they'll continue to increase the holdings of gold in the years ahead. This geopolitical contestation is highlighted by the development of BRICS we've seen this year. The push to expand BRICS was driven by China, and we saw that being done in South Africa this year. And if you look at BRICS now, it's become a serious global conglomerate. You've got the BRICS countries being 1/3 of global GDP. It's bigger than the G7, and you've got them being half the world's population and over half of the world's energy production coming from the BRICS countries. So it's a serious consortium. They've also indicated a desire to launch a BRICS currency. It's still very early days, but if you do see a move to a BRICS currency, it's likely to be backed by a neutral reserve asset like gold. And if that happens and gold gets remonetized, the upside for gold in that scenario is very significant.
So, Rashaad, I just want to unpack a few things because there were lots of moving parts in your thesis there. One of the things that you mentioned is a potential oversupply of US government bonds. Now, if there's too much of anything, we know that bond prices fall, which means that the yields are rising. And if yields are going up, then typically gold prices would go down because of the opportunity cost of holding gold. Wouldn't that be the case if there was an oversupply of bonds?
Yes, Linda. So gold has a very strong relationship to rates, especially real rates. And in an environment where your US yields, short-term yields are 5.5%, that's a big drag to the gold price because gold doesn't yield anything. In fact, it has a carrying cost. So it's very difficult to justify holding gold at zero when you could be earning 5.5%. And I think that's why you haven't seen gold perform this year. The fact that it's still close to that 2000 level shows the consistent bid that gold has seen in spite of the drag from real interest rates. So in a scenario of higher for longer, where we see a repeat of 2023, where the Fed is able to not buy bonds and maintain interest rates at a higher level, I think that my scenario won't pan out, but I don't see gold pulling back significantly even in that scenario because you continue to see a bid from the central banks.
Okay, so you're definitely a gold bug. I have to ask on behalf of the Bitcoin bros, is Bitcoin not making gold irrelevant over time?
So I think if we had to have this conversation in 10 years' time, it may be a different story because Bitcoin does have some advantages in terms of holding, custodying Bitcoin, being able to transfer it. But I think it's still way too early. Gold has, millennia of history. It's still key in the financial system, and importantly, it's still held on central banks' balance sheet. It's still a reserve asset. So, in a scenario where the debt problem is currently out of control, in a scenario where the central banks would be forced to intervene and backstop the bond market again, that's not a story for 5 or 10 years away. I think that is going to happen in the next year or two. And if it's a near-term issue, I think gold is still better placed to play the role of a global reserve asset as opposed to Bitcoin.